Hi all, my name is Ikedichi Kanu. You can also refer to me as IK for easier pronunciation. So I'll be here to speak to us about risk in the digital lending space. Just a short presentation, looking at risk in the digital lending space specific to Nigeria and perhaps Africa. I'm currently the Chief Operating Officer of Ashanti Group, based out of East Africa, Kenya to be precise. Hopefully we'll be in Nigeria in a few months' time. So we're looking at risk in the fintech space, and we are going to look at the financial service proposition and opportunities for fintechs, the nature of fintech loans and benefits, important country readiness considerations, and then the post-COVID impact of fintech in Nigeria's landscape. So when it comes to fintech, fintech brings a lot of, I'm talking about fintech in the financial services space. It brings in a lot of value proposition from the area of payments, savings, lendings, value-added services, and account management. This conversation will be strictly on lending, and you will understand why I'm focusing on lending. If you look at these statistics, these graphs, this chart.
Sorry to disturb you. Are you to interrupt? Are you sharing your screen or you're just talking through?
Oh, sorry, I thought I shared it. Just give me a second. Let me go back again. I'm sorry. Okay.
I think you can go ahead and speak.
Okay.
If you're not able to share, just go ahead and talk to the paper, please. Yeah.
Okay. Can you guys see it now? Is it there?
No, not yet.
No, we can't see, but it doesn't matter. Just talk to the paper so that we can.
Just hold on a second. I think it's loading up. Okay.
Yeah, we can see.
Okay. So I'm sorry, guys. I'm sorry for this. I think it's my error. So I'm going to share my screen here. Yeah. So risk in Nigeria's fintech space, in the Nigeria's digital lending space. And so we're looking at the major value proposition of fintechs in the financial services space, and I'm specifically focused on lending. Beyond lending, there are other financial propositions. There's payments, there's savings, there are basic financial account service management for bills payments, and then wealth management. So these are also other value propositions in the financial services, but I'm focusing on lending for a particular reason, for the purpose of this conversation. Now, if you look at this slide, you will see that in the US, and by the way, this is across board. This is just one of the numerous big spaces where fintech is playing. You see that in the financial services space, fintech is really going hard on lending, in the lending space, especially in the unsecured personal loans space. So you see that in the last, from 2013 to 2018, 5 years interval, it had grown by about 33%, while other lenders, the banks, the credit unions, and other traditional lenders were dropping. Fintech is growing very aggressively. And this is a trend across board. And there are many reasons for this. If you look at this chart here, you will see that it's on the left-hand side, you will see that the growth is actually coming from the lending, financing, and payment space, more in the retail segment and the commercial segment. So, and if you look on the right-hand side, in the Nigerian ecosystem, the same thing is going on. So the one on the left is the global trend, and on the right, you have what's going on in Nigeria, the same pattern. You see that in the consumer and SME space, particularly in the lending and payment space, fintechs that's where the massive growth is going on. Now, other segments will grow, but for now, that seems to be where the focus is. And it's not by chance. It's largely because those are low-hanging fruits, and those are the ones that give you the immediate value proposition. People want to make payments efficiently, effectively. people want to borrow money very quickly and efficiently. So it's not by chance that's why you have the fastest growing segments in the fintech lending space. By nature of digital loans, I just want to just take us through some of the things I've observed. And by the way, this is not an exhaustive list, but digital loans are basically unsecured. What it means by being unsecured is that they are not tied to any physical collaterals. They are usually given based on customer behavior over time. Whether it's behavior by the way they use their phones, whether it's behavior based on how they use utility bills, or whether it's behavior based on how they purchase stuff from retailers, but it's based on behavior, not on collateral. It is also so it's driven by behavioral data, and that's also one of the weaknesses of digital lending, because data can be influenced too. And then because of that, models are built around this behavior over time. So you have all sorts of models, machine learning models, which are wonderful. They are meant to predict customers' behavior based on their historical behavior. Unfortunately, those models can also be susceptible to systemic changes, over time. So, for example, we found out that in Kenya, in the business in Kenya, we've had the model shift very significantly, simply because of COVID. COVID has moved things in a direction, and so the models have all moved in a certain direction. So they became initially less predictable, and they will have to make adjustments in view of the new market environment. And then they start becoming good predictors of customer behavior. It's a scale game. So digital lenders typically want to go to big markets because it's high volume, low value transactions. You must have scale. If you don't have scale, then you have no business being digital lending. It's essentially the direct opposite of banking lending. Banks are not usually bothered about volume. It's so much as value, so a better balance of volume and value. Why digital lenders are looking at volume transactions. So the benefits of digitizing our lending process. The typical traditional bank has a normal process-driven lending, process-driven lending, which is based on having the 5 C's: character, collateral, and all that kind of stuff. Digital lending is totally different. It's codified, automated. And so sometimes people might tend to ask, what's the value of digital lending? For those financial fintechs in the financial services space, the value comes from many angles: from the revenue side, from the risk side in terms of cost, and from the operational cost too. So on the lending side, you will see on the revenue side, it makes it faster to give loans real time. So like in Kenya, our merchants can ask for loans, and in less than 20 seconds, they've gotten their loan topped up immediately. They've gotten their ID, we've checked the credit bureau, we've checked their payment history, we've done all the regular checks in 20 seconds, and we can offer them a loan. That would never be possible with a traditional bank. And by the way, there's no collateral. The collateral is their credit history and their transactions, either airtime transactions or utility transactions or something. So it's fast, and it improves sales opportunity by between 5 and 10%. The other thing it does is that it reduces cost of, it also improves our predictions. Because we are using models, we can predict behavior better. It's easier to predict. Now, of course, you also have misses, but as the models get better, they can predict people's behavior. So we have what they call probability of defaults. The models can come up with probability, and we can say, if Mr. X asks for a loan, this is his probability of default based on these parameters. And it comes from all sorts of interesting parameters, from his utility payments, from his airtime data payments, by his age, the gender, where he's located, his current banking transaction on the records on the credit bureau, and any other source. So we use that, and we can come up with figures and then offer him something. In fact, we also have psychometric tests, which can also ask him a set of questions and or patterns, and based on his choices, can make an informed guess of an offer to give this individual. Another good part of it is that because of digitization, a lot of back office work is reduced, paper costs, errors are reduced because it's all digitized. And so you see a net benefit in digitizing the lending space. The chart on the right breaks down the lending process, the different steps in lending, the strategy, the sales and planning, pricing, analysis, scoring, application, decision, the contracts. Now, all these steps used to be done manually, or in some banks, or the traditional bank used to be done manually. For the fintechs, we will do all this stuff automated. It's all automated. Everything is automated. We can do the analysis, we can score you, we can offer you a contract, which is normal terms and conditions you see on the phone, asking you if you want to onboard onto this service, these are the terms and conditions. Everything is done online. And so if you look at what you have on the right-hand side here, you see that you see the impact it has in terms of these different steps. You see the impact it has in terms of the revenue potential improvements, the potential for revenue improvements, the potential for cost reductions, and the potential to reduce risk. And they're all weighted there. So, and then based on the capacity you have on ground, based on the country readiness level, you can now decide which is more important to you, which gives you more importance. So I will share some experience with you here, so you understand what I'm talking about here. So you could go to one country and certain constraints in that country doesn't allow you to automate part of this process as efficiently as what is given in another country. And I will share my experience with Kenya vis-a-vis, say, Nigeria. So talking about country readiness level, they're talking about, people always look at Nigeria. They say, oh, Nigeria is a big country, 200 million people. I don't believe those figures, but that's what everybody says, 200 million people. And they say, wow, why don't you just jump down to Nigeria? Yes, Nigeria has 200 million people. That's beautiful. But that's not the only thing about, that's not the only driver of a decision. Okay, how many of them are banked? How many of them are unbanked? How many of them are underbanked? You have to understand that, so you know the real market you're dealing with. You have to look at the regulatory licensing requirements. In some countries like Nigeria, getting the license can be tough. We're talking about sometimes as much as from 3 weeks to months, 9 months, 10 months, 11 months. Capital requirements, deposit this, drop that, all sorts of things. Data protection requirements, huge. In some countries like Rwanda, you can't even talk about moving data to the cloud. It has to be hosted in country. Nothing moves to the cloud. Then in some countries, the knowledge level is low. So we've had a situation like in Mozambique, where they had never done mobile money before. How much more lending? So it was an interesting one, going with the telco as a partner to talk to them about mobile money. They had heard about it in Kenya. They had never seen it before. They don't understand the concept. To explain to them, to help them to come up with a framework, and kind of work with them, and then come up with a structure to make it work. And by the way, Mozambique is actually an unforgettable experience, because even though the guy is speaking English, all communication must be done in Portuguese. So you have to write in English, they translate it to Portuguese, they send to them, they respond back in Portuguese, and if you're lucky, they maybe attach a transcribed copy in English. So it makes the whole thing protocol very hectic. Other things you have to consider in a country, going to a country, that things like availability of national ID cards to verify these individuals. That's where Kenya has really done a good stuff. Kenya and East African countries generally have ID cards. So on the back of those ID cards, you can do automated lending to people. It's so easy. It's amazing how this thing works when you have a national ID card system that works. So on the back of the national ID card, they have functional credit bureaus. So in Kenya, I could put in your ID card number and we will give me all your information immediately. Fantastic stuff. They have, in some countries, you have address verification systems. Very important. Okay, the man says he lives here. Does he really live there? Very important. And then other systems that do help. Some tax, some NHIS information. You put it in and it gives you back information. Especially if you're looking at ecosystem lending with employers, for example. These are easy places to information. So ability to get these data sources and connect with them, very important. Also, availability of transactional data, either from the telco or from the retailer or from government, very important. It allows you to know how to offer this individual credit. So I remember in Rwanda, the electric metering system, they use this smart electric metering system. And so you could give credit on the back of it because you knew who owned the meter when he takes power. So you could look at his metering history, his power consumption history over the years, and then come up with what I'll call a small credit, so that anytime he runs out of power and he can't get buy power, he can just take a credit immediately that can last him for 48 to 72 hours. And then when he buys power back, you get your refund and a small fee for providing the service. That is doable because the electric company there works quite efficiently. Another concern is the area of currency risk and capital flows. Very important. I've been worried about the fintechs. About a week ago, I spoke with the CEO of one of the fintechs that has just been celebrated for the huge investments, some US dollar investments. And I was asking, okay, so how does this work for you? How do you intend to, how does it work in terms of returns? So you're bringing in FX into a country that the currency has devalued by at least 35, 36%. The real markets, the markets, And then how do you encourage people to come in with this kind of risk? In East Africa, that it's not exactly the same. In Kenya, their currency has devalued by about 3.8%. So that's marginal. So if I was an investor bringing money in, that would be a factor to consider. Other important things that ease business to make a whole lot of difference. You want to get into the port of entry. How easy is it to get into the port of entry? Are there flights you can hop in and get there directly? When you get in, are there visa on arrival? How easy is it to get visa on arrival? Are there direct flights? What's it like when I get in late in the night? Can I get to a hotel, or do I have to sleep at the airport the next day? All these things make a whole lot of difference. So some countries are better designed to come in and do business in the fintech space than other countries. In terms of regulatory approvals, East Africa, Kenya in particular, you can start digital lending on the back of nothing. But once you want to go into savings, you now need to get a license. Some other countries like Botswana, for anything you want to do, you must get a license. In fact, you must get a banking license, a full banking license. So it makes life very difficult. So the environment, and these are things that Nigeria has to look at too, to make it easy for people to jump on a flight, come down here, get a visa, walk in without knowing anybody, set up something, and get moving. These are part of my experiences. Also, the skills, availability of skills. We've been looking for a couple of skills. So, for example, we are looking for somebody who has data analytics skills, and there are so many in the market. But not just technical or functional data analytics skills, but looking at somebody who has a combination of data analytics skills and credit skills, data analytics, credit, and industry knowledge. Now, once you combine these three skills together, you find out that you can't find anybody. You really can't find anybody. We've seen a couple of people in Europe, but they become very expensive. So we need to look at the right skill sets that can do this job for us, so that we can get locals and employ them. We have a few Nigerians who are doing very well, but like I said, it's largely functional skills. They are good at that little That's data analysis. But it's not just data analytics. You have to make the data to speak to the business. So you need somebody who understands credit skills combined with data analytics and an understanding of the industry. And so things like that. So we are still going through that maturity curve when it comes to the area of analysis, data analysis, and the credit risk. My last slide is on the impact of COVID-19 on the Nigerian fintech space. I've talked about some of this already. Currency devaluation, Naira has moved quite significantly. So if you made an investment in a fintech in Nigeria in the last 1.5 years, and you see you have a equivalent tax on the returns. How do you get these returns back? You have to probably look at your projections again and rework them. And there's no guarantee that it will still stay the same. So something that we have looked here. It's not only here, it's everywhere in Africa. The commodities markets have, exporting markets have been hit badly by COVID, but some countries more than others. And so local investors, so most of these fintechs have to look at opportunities to get local debt to finance their growth. Naira to Naira. It's easier that way than dollar to Naira. We're also looking at the issue of disruption of employment. People have lost their jobs. And so people who normally wouldn't default are defaulting. So we've had a situation where the model has shifted very significantly. And I know in Kenya, we had to literally shut down our borrowing for a few hours to look at how we could shift the model back again, quickly reevaluate the situation, and then loan money to people who can still survive. So we find out that certain businesses were still thriving. In fact, initially, my greatest surprise was that the restaurants and the drinking, the bars, we thought would get affected by the government instruction that they should shut, or everywhere should shut down after 7 o'clock or something. But that wasn't the case. So we reached out to a few of these guys to find out what is going on. And they said, our customers actually ordering online. And then we are supplying them with delivery bikes. So people were still drinking, and the Kenyans love to drink. They really are a jolly good set of people. And so you see that some businesses were still thriving. Some sectors, some industries were totally knocked down. But some creative guys too also had other options around it. They walked around. Some came up with, some of them started cross-selling other products, to expand their base and thrived. But generally, you had a massive downtime, the sector. So as a fintech, what you have to do at that time is to look at your numbers very carefully, do very deep analysis, and have a structured, focused way of identifying clusters of opportunities and keep leading to them, and then shut down the rest of the system or reduce the limits, give it to the other part of the system. So it was an interesting one, trying to identify these clusters, because again, most times you don't have that information. You're mainly on the back of behavior or data that might not reveal the kind of businesses or the kind of occupations these individuals are involved in. But over time, you start seeing patterns, and then you can deal with them. Then, of course, they had regulators coming in and creating more problems in the process of trying to solve a bigger social issue. Sometimes they created more problems. So sometimes they say, waive all the fees. And then that becomes a loss to you automatically, Or sometimes they say, okay, you can, any loan that goes after 90 days, don't book it as a bad loan. Instead, extend it. So it's still looking as non-performing, called that regulator-induced profits. So on your books, it's showing that it's still performing, whereas in actual fact, it's not performing. But the regulators say you should do it that way because they don't want the market to crash. When you have challenges like this, the regulators have to come in and play their role from a social perspective, which is very important. And then lastly, you have the digital adoption. So you had a lot of people moving online. Businesses are still moving online very aggressively. Everybody said, realizing that, look, I can do things more efficiently, more effectively. Why do I have to do this?